It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. I got a cold back again. This is just like so frustrating. My girlfriend said, if you get a cold, you're going to get it back again, and I got it back again. So anyway, if I sound like Froggy the Gremlin, it's just me, Esther Gulius, the Tax Lady. We want to help you with your taxes. We're in the height of tax season. You must have most of your stuff, the 1099 Bs probably aren't out yet from your broker. Many brokers aren't out. And I got Chris Fabian here out of the office. Hey, Christopher.
Hello, Esther.
Hello, Christopher. We're having fun, aren't we?
Yes, we are. Can't complain today.
Yeah. Oh my gosh, and it's so gorgeous out.
Yes.
It is
oh
so
my
gorgeous.
God.
I want to play.
Can we?
hooky.
I was
Can
just
do
going to say, do we
taxes
have
on
to go back?
I can't believe it's February. Anyway, I'm Esther Gulius, the Tax Lady from EG Tax. 803-0930. 803-0930, star 930 on a cell phone. And I know we've had Patty holding, and I wanted to get to her because she was bright and early, Patty. Hey, Patty, how can we help you?
Yes, my question is this. I took an IRA distribution out last year, and I rolled back into the same IRA part of the money. Now, I got a 1099-R for the Internal Revenue, and it just shows the total amount that I had taken out, but not what I rolled back into the account.
I mean, what makes you think you can roll it back in? How you took the distribution for how long did you have it for, Patty?
Of taking it out.
No, how long did you have the distribution that you said you rolled back in?
Less than 60 days.
All right, so you took some money, and it wasn't an RMD, right?
Yes, it was.
All right, so your required minimum distribution you took out, and then you put part of it back?
I took out more than the minimum.
Okay, so you put back the amount that was over the minimum, correct?
Yes.
Okay, so what you're going to do is you're going to mark as taxable only the part that
you kept,
the RMD, and then and you basically are only going to tax you. Now they may write you a letter and ask why there's a difference, and then you'd have to show documentation that you had put back the money that you shouldn't have taken out from your RMD.
Well, on the 1099-R.
I know, Patty. It says the total amount.
Right. So, as an example, if it said 10,000 in box 1 and 2, you put the 10,000 on line 15A, and then on line 15B on the 1040, you're going to put what you kept. So, if that was 3,000, you would put 3,000 on 15B.
Right. And then you save the documentation, because they probably are going to write you a love letter, and then you're going to have an opportunity to explain why you didn't tax yourself on the full amount, that you had rolled back the money.
On my monthly statement, it does show the rollback.
I understand, Patty, but you see, when they give the 1099-Rs out, all they care about is how much you actually took back, and then when you do your tax return, you put down the correct information.
On that 1099-R?
No, on the 1040.
Oh, on the 1040.
Right.
I see. So the firm that did this, I don't have to ask them for clarification?
No, they're not going to, because they actually did give you that amount. Then the part that you rolled back in, that it won't come out of the laundry, so to speak, till the next year. So that's when you do this distribution. On 15A you put your gross amount. On 15B you put what you actually kept.
I see. Okay, thank you.
All right.
Much.
Thanks, Patty. I'm Esther Gulius, the Tax Lady.
803-0930.
803-0930. Star 930 on a cell phone. And we got people hanging, but we wanted to talk about a little bit about itemizing and some of the things that people need to take into consideration. And obviously the first thing, Chris, is medical.
Yep. Oh, a lot of people think, I can't hit it, but with the high costs of everything out there, prescriptions going out there, if you have insurance through the exchange, or through your retirement, that all counts.
That's right. Many times retirees don't realize that they realize they're paying it, but it's deductible. If, let's say, you're somebody that is retired on a pension and they take $200 a month or $300 a month to pay for your health insurance, that's $3,600 that's deductible, plus your Medicare portion, plus all your prescriptions, plus your deductibles. If you maybe have a floor up to $7,000 or $8,000 before you get anything paid for, that's all deductible. Things like acupuncture and air conditioning at the advice of the doctor because of a medical condition are deductible. Birth control pills prescribed by the doctor. Can't like for special schools for special needs kids are deductible. Like, let's say you have a child with a special learning disability and you put them in a special boarding school. That's deductible.
That's a medical expense. Yep. Orthodontists. I mean, that's a huge one. Dental work. All these things count towards medical. Your prescriptions, like we said.
Plus
your mileage. It may not be much for mileage, but it helps, and any little bit can do it.
Your dental treatments, diagnostic services. If you are in a drug rehab facility, or God forbid your kids are and you're paying for it, you might have a child that you can't claim as a dependent because they make more than $4,050 a year, but you just paid for a drug rehab for them, and you would claim them, except they made more than $4,050, and technically you're supporting them, but you can't because of their wages. You can take that as a medical expense.
That's right. I mean, you got to use everything to your advantage.
That's right. All right, let's go. And again, I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on cell phone, and we're going to go to Deb in Lancaster. Hi, Deb.
Hi, how you doing?
Good.
I have a question about my claiming what the basis is for a home that was sold.
Okay.
My mother and father-in-law signed their home over back in 1990s to their sons. It was in some form of a trust. Okay. In 2010, my mother-in-law passed away, and then my father-in-law continued to live there. Okay. So 2016, my father-in-law moves in with me, and the house is sold.
Mm-hmm.
He passes away in 2017, and he gets, he had gotten 10% based on his life expectancy, and both the sons got 45%.
Because it was a life estate.
Pardon me?
Because it was a life estate.
Yes.
Okay.
So how do I figure the basis of the home now? Because it's going to go on my return and my brother-in-law's return.
All right. So if it's a life estate and it goes through the estate, then what you're going to get is a stepped-up basis upon the date of your father-in-law's death.
Okay.
Which would mean you're not, if you sold it right away, there would be no tax because the gain wouldn't be there.
So let's say upon his death, let's say they bought it for $15,000, but upon his death, it was worth $95,000. And if it was in a life estate and it went through his will, then you're going to get the stepped-up basis of $95,000, so there won't be any gain.
Okay, but it wasn't. I don't think it was in the will. We got a 1099-S for it.
I know, because it was a life estate, and
okay,
and that meant that the kid's name was on the title, but Dad and Mom steered the asset. So to make sure, talk to the attorney, because when you said that he got 10%, that meant that his name was still on the deed, which meant that probably it's a life estate. So just make sure that you write down this life estate. All right. Okay. Ask the attorney that closed the property, was it in a life estate? Now, if it wasn't, and they had actually, but I don't think it could have been, but if it wasn't, then it goes back to the donor's original basis, plus their improvements. So there would be quite a capital gain. So that's really worth the phone call.
Okay.
Okay?
Thank you very much.
All right, you're very welcome.
Okay.
Thanks for calling. I'm Esther Gullius. I'm Esther Gullius the Frog from EG Tax. We want to help you. 803-0930. 803-0930, star 930 on a cell phone. I got Chris Fabian here. We want to help you with your taxes. We're going to take a short break. and we'll be with you on the other side. Now that's some doing taxes music, right? Not sitting at that desk looking at those forms. That's good tax music. I'm Esther Gullius, the tax lady from EG Tax, here in studio with Chris Fabian. Hey, we got all of our offices open, 9 to 9 Monday through Friday, 9 to 5 on Saturday, and we sure want to help you.
2 offices open on Sunday. Let's not forget those. We have the McKinley Mall open from 11 to 5, and we have our Factory Outlet Mall open 10 to 5 on Sundays. So we got you in the south side and the north side.
That's exactly right. All right, I know we got our phone calls hanging here, but I want to talk to people also. We're talking about medical. Don't forget your long-term care insurance premiums, because it's not only a medical expense on the federal, but it's also a credit on New York State.
Right. It's, and that's a big credit, and that carries forward year after year.
Right. So it won't. It's not a refundable credit, but it'll wipe out your liability.
Yep.
All right. Let's go back to the phones, and we'll talk to Mr. Sam. Hey, Sam. How can we help you?
Yes, I'm going to explain the problem and then listen on the radio if you don't mind.
Not at all.
This concerns gambling winnings and losings.
Okay.
Losses. Both sums, I had documented winnings and losses, and both were sizable amounts. And on the 1040 of line 21 of 1040, the preparer took the large winning number and put that in as income, which put me in a different tax bracket, several tax brackets higher, and they took the winnings actually were about $5,000 or $6,000 more than the losses. On the Schedule A, what happened? It knocked me out of my standard deduction, which would have been a sizable amount. I couldn't take the 15% any longer. I had to itemize, and on the itemized deduction, they put it in on line 28. But basically, this knocked me out of things like, it put me in a different tax bracket, and it also cost me money on the deductions.
Right. So, okay, Sam, do you want to listen or you want to hang up?
Yes, I'll hang up.
All right, good enough. All right, so this is a common problem. The return that Sam is describing is absolutely correct. Yep. Your gambling winnings, all your winnings go under the income portion. So it's on line 21. Your deduction for gambling is an offset, but it's a miscellaneous itemized deduction that is not subject to 2% up to your winnings. So if he won $100,000 and he had $95,000 in losses that he could prove, he could take an itemized deduction for the full $95,000 plus his property taxes, medical, his charities, et cetera, interest that he pays on his mortgage, and that's the way it would be. Now, here's the other problem that happens, is that it makes the Social Security that may not have been taxable before. He thinks he's in that much higher tax bracket. It's probably because of his Social Security.
Well, Social Security, right, but he could have won a large, right, so it's making his Social Security taxable. There's nothing you can do to offset that. But then he could also be losing his Senior Star,
his Star program,
his
right.
Epic program.
Yeah.
I mean, because that gambling, if it was such a big win, that unfortunately does go on page 1 of the 1040 where all these other benefits
and
go
what
off
people
of.
want to do is net it and put it on line 21, but that's not correct.
No.
And in the event of an audit, or if they get the statement from the gambling, from the casinos, which they do get, they come in many times with these, what are they called, jackpots?
Yep.
And the IRS knows you got the jackpots, and if you did it that other way, it would be absolutely incorrect.
Right. So
it was done correctly.
Yeah. If you won $75,000 in a jackpot and you lost 70 and you want to put 5 there, the IRS knows line 21 should say 75,000.
Right.
So in a year you would get a letter for a bill.
That's right. And then it would be devastating to you because maybe you didn't tax your Social Security correctly, and they're going to charge you penalty and interest. So that's the conundrum when you go to the casino, you know.
Yep.
So, good question, and I think we also had somebody call and say, explain a life estate again. Chris, you want to?
Right. Well, a life estate is what when older, not even older, it could be any age, you can put your house in what's called a life estate to protect it from a nursing home in case you think you're going to go into a nursing home. So then you put your children on it. And so slowly you lose ownership of the house up to where you only own 10%. So then once, like Esther said, if the house passes through the estate, the children at the time of death inherit the house and they get a stepped up basis.
Which is a good thing.
Right.
That's a good thing. In other words, what it's worth upon the death of the donor, it becomes your basis. So when you sell it, there's not a gain.
Right.
Or very
right.
little gain, or no gain at all, right?
Yes.
So somebody wanted to answer that. No, let's go back to the phones and we'll talk to Dominic. Hey, Dom, how can we help you? Dominic.
Oh, that's...
Hey.
Hi, yes, sir. How are you?
Good.
I have a question regarding Social Security lump sum payment father received. Going back to 1991, he got a letter saying that they made a mistake, and he was owed $41,771, so they sent him a lump sum payment of that amount.
In 91?
From now,
it goes
back to...
Oh, to 91. Okay.
Yeah, so that's roughly 26 years.
Holy moly. Okay.
So my question is, how do you treat this on the tax return?
All right, so how much did he really get? What's the real numbers, Don?
Well, $41,771 was the lump sum payment, and plus his other benefit, which is normally just about $19,000.
All right, so he's looking at $60,000, right?
Right.
Is he married?
No.
Okay, so half of that would be 30. All right, so here's the thing. Does he have any other source of income?
He has a small pension.
How small?
$5,000.
All right, so here's the math. The $60,000, half of it would be subject to see about the floor. So $5,000 of that is over the 25. So he's $2,500 ends up being potentially taxable with his pension. He's going to pay no taxes. If he just does his tax return per normal, he's not going to owe any taxes.
I'm sorry, I didn't quite understand it.
Okay.
If his only income is the $5,000 from his pension, right?
Okay.
So you take half of his Social Security, so that's $30,000, okay, plus his pension, that's $35,000. So that's $10,000 over the taxable Social Security limit, which was $25,000. So take half of that is $5,000. So $5,000 Social Security plus $5,000 pension is $10,000.
And he's not going to owe any.
And his standard deduction and personal exemption is going to zero that out. So he owes no money.
Right. No problem.
Oh, okay.
Okay?
All right. I was also under the impression that you might be able to spread that lump.
But you don't have to because none of it's taxable without doing the lump sum election. So why do all the jumping through all the hoops when it's not taxable anyway?
Right. Yeah. Well,
all right.
That's a good point. Exactly right.
All right. Good question, Dom.
All right. Thank you.
Thank you, sir. Bye-bye. I'm Esther Gulias, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone, talking more about itemizing, and that's kind of interesting that everybody's talking about it. If you're somebody like that gentleman that called and said that knocked them out of standard deduction, quite frankly, you don't use the standard deduction unless you have to use the standard deduction, because the standard deduction is like the minimum amount they're going to let you to write off.
Right.
But if you can itemize, that's better.
Yes, because that's a higher subtraction amount.
That's exactly right. So once you've gone past medical, then you go to taxes. And one of the important things, especially for seniors in New York State that are retired on a New York State pension or they're not paying any New York State income taxes, is the sales tax deduction, where many people do that incorrectly because we're in an 8 3/4% county or an 8% county if you're in the other less expensive counties like Niagara County. And the chart that is available to you is a 4% chart, And so if you're taking your sales tax deduction off the chart, you want to make sure that you increase it by the appropriate step up. Right, Chris?
That's right. That's right. You know,
And
or
you
you
can
buy a
add-
car.
right.
You buy a car, a motorhome, a boat, a motorcycle. Those sales tax gets added to the chart figures. And that's where, you know, that gentleman with the gambling winnings, hopefully they use the sales
That's
tax
right.
because, you know, that could have saved him some money there.
That's exactly right. So let's go back to the phones, and we're going to talk to Don and Leroy. Hey, Don.
Hi, how are you?
I'm good. What's new?
Good. Hey, I have a property in New Brunswick, and I was wondering if I've heard you talk in the past about the dollar limit that you have to do something special with your.
Oh, you mean the
F-bars.
F-bar.
Yes.
Okay.
So if I keep less than $10,000 in a New Brunswick bank, am I okay?
Yep.
$10,000 US dollars.
Right.
Okay.
Well, in Canadian, 10,000 Canadian would be more like 8,000 US.
Right.
Right?
Yep, it's about
No,
20%
opposite.
rate right
It'd be
now.
That's the opposite.
Yeah.
Right. If 10,000 Canadian
Is 8,000 US.
No, it's
Okay. So
yeah. No, it's more.
anything
The-
special with my filing?
Pardon me?
I don't have to do anything special with it.
But for those of you that are listening, the Canadian. Oh, I got to take my break. Oh yeah, I'm talking too much, Don. We got a break for news. If you want to hang on, I'll talk to you on the other side. Hey, this is Esther Golias, the tax lady from EG Tax, and we want to help you with your tax questions. 8030930, 8030930, star 930 on your cell phone, or any of our 33 area offices. We would love to help you. I'm going to go back to Don and talk about F-bars. Okay, so the F-bar is the requirement to file with the Internal Revenue Service to let the Federal Treasury to let them know if you have assets outside the United States if you're a U.S. citizen. So you're good, Don. So you can keep, like right now with the exchange rate, like $10,000 or more actually Canadian income, and it'll equate back to less than $10,000.
Okay.
All right.
So I don't have to do anything.
You don't. You're good to go. But you got to watch that. Make sure that you got to watch the exchange rate, because if the exchange rate goes the other way, then you might have a problem.
Okay. Very good.
Thanks, Don. Bye-bye. Let's see. We'll go to Tim in Blaisdell. Hi, Tim.
Hi, Esther. Thanks for taking my call.
Yeah.
Hope it's a simple question. My daughter is purchasing a house for me. I hold the mortgage on it. Where do I report that on the form, or what line on the form do I report the income I receive?
Okay, you're going to report it twice. You're actually holding the mortgage, correct? So you're doing an installment sale. Was it your personal residence before? Pardon me?
It was my personal residence before. She now lives there.
How long ago did you live there, Tim?
3 years ago.
Okay. So did you live in it 2 out of the last 5 years?
2. No.
You didn't. Okay. All right. So the reason I'm going down that aisle, Chris, you'd know, is that if he had lived in it 2 out of the last 5 years, it would have been a sale of a personal residence.
And tax-free.
And then all he would have had to do is claim the interest.
Yep.
But because it turned into investment property, because you didn't live there anymore, you have an installment sale on a 6252, and you're going to report the gain on a 6252.
Right. How much did you pay for the house?
When I bought it, it was $18,000.
How about your improvements, Tim?
We sold it for $80,000.
Okay, but what do you think you put into it in improvements?
Oh, probably $75,000-$80,000.
Okay, so if you bought it and you sold it for a loss, then you're going to take the loss on a Schedule D. Oh no, you can't, because
it's family
you're selling it
member.
to a family. Wrong. Cancel that. But if it wasn't a family member,
then you could have. Yep.
Right. So you can't take the loss because it's a family member. She gets your adjusted basis. So when she sells it, she could take it as a loss. And if she sells it to a non-family member, but the interest is going to be reported on a Schedule B. So you're going to keep track on your amortization schedule of the interest that she's paying you. You're going to report the sale on a Schedule D. You're not going to take the loss. It's going to be a wash, and that'll be it.
Schedule D is where I report that.
Right.
The
Schedule
sale.
D, and then Schedule B for the interest she's paying you.
Yeah, forgive me. I also have the hockey game on in case you're interested. But
Are we doing any better? How are we doing?
At 3-2 with 1 minute left to play.
Okay.
Oh, and we're up, right?
You are up.
Hey, that's good. But anyway, all right, the Schedule B.
As in boy.
And boy.
For interest.
Okay.
Schedule D, like dog, for the sale of the home.
Okay.
All right?
I thank you very
You're
much.
very welcome. Bye-bye.
And then he also has to record her name and social security number on the top part of the Schedule B, so that interest he claims as income matches
take, right.
her itemized deduction
She
for
can
the
take it
interest.
as an itemized
Yes.
deduction. Right. Correct. All right, let's go to Dave in East Aurora. Hi, Dave.
Hello, Esther.
How are you, sir?
Oh,
Pardon me?
I said thank you for taking my.
Oh, my pleasure. What can we do for you?
Okay, my question is, I have a trust. I was executor to my aunt's will, and she left my son some money.
Okay.
But my question is, can I transfer the money? He doesn't want me to give him the money because he says he'll spend it. I have a bank account already. Can I transfer the money from the account in the trust? It's under a separate ID number, and put it into a bank account with my name and his name on it without any tax implications.
All depends on what the trust's wording is.
Right. You have to do what the trust says.
Yeah, well, that's it. Again, it says to give him the money.
Okay, so if you give him the money and he puts it in a bank account with you on it, that's up to him. It's going to be a taxable event to him.
It's a taxable event either way.
Well, if there's taxable money that's being distributed from the trust to the beneficiaries, and the beneficiaries get a K-1 because the trust is not paying taxes itself, and the beneficiaries are the one paying the taxes, then yes, it's going to be a taxable event.
Yeah, well, I've been paying taxes right along on it.
All right, so does the trust pay its own taxes or not?
Yes.
Okay, so the trust is paying the taxes.
Yeah, I had to set up a...
How is the money invested?
Actually, right now it's just sitting in a money market account.
Okay, so it's just earning interest. So yeah, you can cash it in. The interest for the year would then go on the trust return, and then the money, any interest earned going forward, once it's in your name and his name, it would go, if he's listed first, it would go on his return.
Okay, yeah, because I want now the amount of interest earned. It's like I said, it's like a $29,000
CD, yeah,
$80, and I did that this year already. Actually, Robin East Aurora did it for me.
Okay.
And now when I close it out, I mean, it's only going to earn like $2 maybe.
Right.
So what is the limit that, like, if I close out this account and I do it like final tax return for this year or next year, okay, 2017, is there like a minimum? Can I do it like on the 1048, or do I got to go pay somebody another, $80 to do?
You mean for your son?
You're talking about the 1041 on the trust, or your son?
For my trust.
Okay, so there's a $600 exclusion on the trust if it's not an estate return.
Yeah.
So if you're under $600, you're fine.
So I don't have to do anything?
Right.
Oh, really? I don't have to close out that tax ID number?
I thought you said you're closing the trust.
The trust, I'm calling it the tax ID number, has a separate trust.
Okay, but if you're taking the assets out of the trust, then that would be the final return.
Oh, okay.
Okay.
All right, Esther.
All right. Thank you, sir.
All right.
Have a great day. I'm Esther Gullius, the tax lady from EG Tax. 803-0930, 803-0930, star 930 on a cell phone. Chris and I are here until 4. We'd love to answer your questions.
Definitely.
You got something you were going to say, Chris? You looked.
No. Okay. Trusts are very interesting. You got to watch the bylaws, and because each trust is different.
And I will tell you, you're better off that a trust would distribute and the trustees would pay the taxes as opposed to the trust itself paying the taxes, because it pays at a much higher rate.
Very
much
fast.
Higher rate. All right, let's go back to the phones and we'll talk to Linda in North Tonawanda. Hey, Linda.
Hi, how are you?
Good.
I just have probably a quick, easy question.
Yeah.
My son's 19. He files his tax returns over the phone, last year on his own. He was 18 then, and he tried to do it again, like through that TurboTax. But they're asking him for his I don't know if a number, a particular number that he needed.
It's either his PIN or his prior year AGI.
Right.
I think that's what it was, but he doesn't have it. So I don't know how he can get it, or if he needs to do it through the mail.
I think he can try calling the IRS, and there's a phone option. If you need your last year's AGI, you can get it through the phone system with the IRS.
Okay, you can't do it though through the computer at all. You have to actually call them.
No, you got to understand they're extremely cautious about identity and identity theft, and so your best bet is to call the Internal Revenue Service.
And it's a computer. It's not going to be the waiting an hour for someone to come on the phone.
Okay, that's good. That's what I was worried about. Okay. Thank you very much.
Thank you very much. Let's see. We're going to go to Marcia. Hey, Marcia, how can we help you?
Yeah, hi, Esther. I have two questions for you.
Yeah.
In December, I filed for my Social Security. I'm 66 years old, and they gave me the option of getting, the past due in one lump sum, which I took. And that actually hit my bank account on December 30th. However, my benefits letter said January 3rd, and I have been working full time. So my question is, do I have to pay taxes on that amount for 2016, or are they showing it for 2017?
Well, so the law says if you have access to the money in that calendar year, you're supposed to report it in that calendar year.
Okay, all right. That's what I thought. I just wanted to be sure.
Okay.
My second question is, quickly, I just recently lost my full-time job, and I am thinking of, and I do have a pension with them, what I'm thinking of doing is filing for the pension lump sum and paying off some credit card bills, and then either rolling it back in or getting an annuity or something with it. Would that be the smart thing to do? Or
how old are you, Liz? 66, right?
All right. I'm going to be 67 next month.
All right. So how much are we talking about?
Like $66,000.
All right. So you want to take $66,000 out and use it to pay bills?
It out?
Pardon me?
I said, can I take? All I want to do is.
How much money did you want to use?
I wanted to use about $10,000.
All right. Do you have any other source of income besides the $10,000? And the Social Security?
Not right now, no.
All right. So are you single or married?
I'm single.
All right. So here's the thing. Your standard deduction and personal exemption would mean that you could have taxable income of about $12,000. So the $10,000 is going to be, if you take it out, it's going to be tax-free anyway.
Oh. Okay.
Or very close.
Right.
To that.
I would just take out the $10,000 and let the other $50 there.
Right.
And if you want to roll that over.
Roll that over. When you go to take the distribution, Liz, tell them let's say you're going to roll over 62, but you're going to keep 10. So 52 will go in the rollover, and then have them send you 10.
Okay.
Rather than getting it, because if you get it, you have 60 days to hold it, and they have to take the money out. When you take the distribution. So you want to be very careful that you don't be tempted to take any more out than you need to.
Now, since I don't have a job right now, what kind of things can I roll it over into?
Into an IRA. It's got to go into an IRA.
An IRA. Okay.
Right.
I can get
traditional
bank.
Yes.
Okay. All right. Great. Thank you very much.
All right. Thanks a lot. Let's see. We're going to go to Nancy. Hey, Nance. How can we help you?
I won $35,000 at the Hamburg Casino last year as a promotion they had going.
Wow, that's cool.
Yeah, it was. Can I use my gambling losses against this amount?
Yes. Well, you have to keep track of your losses, and many times you have the little sticker card that they know what your losses are.
Correct.
But the income's on line 21, and the losses are a miscellaneous itemized deduction subject to 2%. Not subject to 2%.
The form that they sent me, it's a 1099 miscellaneous. It's listed as other income.
because it was a prize.
Oh, it was a prize.
So, but in order to qualify, you had to do gambling, right?
Yes.
So, yeah, I would say you can take your gambling losses to offset it.
Yeah, because you were gambling, were you not?
I was gambling, yes.
Yeah, well, I think that it's gray enough. It sounds like you should be able to offset
it.
It
wasn't like you went, I mean, that's gambling.
Okay?
Okay,
all right, good enough. Bye. Having a conference here. Let's see, we're going to go 8030930, 8030930, star 930 cell phone. Love to help you. Give us a jingle. I think we have 2 open lines, and we're going to talk to Liz in Hamburg. Hi, Liz. Hi, Liz.
How are you?
I'm good.
Esther, my question is, in 2010, I bought a condo in Florida. I rented it for 2 years, and then the family occupied it up until last year. Last year, I rented it again, and the tenant is moving out as of the end of April of this year. And in the meantime, I've come across another condo right in the same complex where the owner is willing to take X amount of dollars from me, and we'll switch condos, and I give him some money to make up the difference between our 2 condos.
Okay.
Can I do a 1031 exchange on this?
Sounds like you can. Sounds like you can. Because you identified it within the period of time. But you can't get you have to get an exchanger who's going to take title, so that, and that would be your 1031, and your basis on your property plus any cash you give to him is going to be your new basis.
And you're using the new one as a rental too, right?
I will be, yes.
Yep.
I will be using it as a rental.
Yeah.
Yes.
So I would suggest you call Russ Gullo, because he's a great exchanger and he can work out all the details with you. But I think that's a marvelous idea.
Does he work in Florida? Is he licensed in Florida? Do you know?
I believe so.
All right. There is no licensing requirement for exchangers.
Oh, okay.
So you should have no trouble.
Great. I have another question.
Yeah.
I'm part owner. I own 50% of a home with my mother. My mother is currently in a nursing home, and I'm about to sell the property. I'm sure it has a county lien on it. Will I be responsible for capital gains on my share of that particular property when I sell it?
You live in it.
No, I do.
You do not live in it. And Mom gave you the house. She put the title in your name?
It is half in mine, half in her.
And it's not a life estate?
No, it's not.
Then if you sell it, then you're going to have to deal with that, paying the taxes on it, yes.
I will have to pay capital gains on my share of that particular property.
That's exactly right, if you're on the title.
I am. Okay.
And it was gifted to you, yep. You never paid for it. She gifted it to you, right?
Well, no, we bought it together.
Oh, you kind of didn't mention that. Okay, so your basis is half of what you paid for it, plus half of all the improvements you put into it.
Okay, because it remodeled the kitchen and
right. So let's say you paid $60,000 for it, and you put $40,000 in improvements. That's $100,000. Your half is $50,000, and if you sell it for $120,000, then your gain is going to be $10,000.
And that will be my capital.
And that would be your capital gain
basis. Thank you very much.
You're very welcome.
Have a great day.
You too. Bye-bye.
And
The questions you ask are so important, aren't they?
Oh, definitely, definitely.
Because you can really be going down the path thinking one thing, and then somebody gives you a little piece of it. Oh,
it changes everything.
Yeah, we're going to make a right turn. Let's go to Julia. Hey, Julia.
Hi, good morning. How are you?
No, it's afternoon. Is it morning?
I lost time. I was
having fun. Yeah, what can we do for you?
When about 20 or a little more years ago, I retired. When I retired, I did not take out Medicare insurance.
Okay.
Or any of that.
Yep.
So every year since then,
you've been paying.
They have been penalizing me for. They take about $200 out of my check every month.
Yep.
Is there any way I can put a stop to that, or
not that I'm aware of, Julia?
No, it's a.
Do you have insurance through your retirement?
Yeah, my husband worked for the post office, so I do have that. I'm 90 years old, by the way.
So did you go to them and say you do have insurance through the post office?
To Social Security?
Yep.
Yeah.
I'm sure they know that.
Well, no, they don't.
Know that. They don't know that.
They don't know?
No, you need to call them and talk to them, Julia.
Just so anyone there?
Yeah, well, what you do is pick up the phone, call Social Security, and say, you're penalizing me, and by the way, do you know I do have insurance already?
Yeah, I would. You could even go down if you're in Niagara
But
County.
she's 90. She probably doesn't want to drive.
Okay.
You want to? You're not into driving, are you, Julia?
Yes, I.
Oh, well, that's cool. Go face to face.
Face to face, right on Niagara Falls Boulevard, right by where the 190 is in Niagara Falls. There's a Social Security office. I would go there.
No, I can't do that.
Oh.
Can get to Thompson Way.
All right.
Call them.
Call them on the phone.
And tell them they're penalizing me?
Right, and tell them that you have health insurance already and see if they can't waive it.
Oh, okay.
Okay, hon.
Too late today, but I'm going to do
Well,
it.
they're
On
not open
Tuesday.
today,
You got to do it on Tuesday. They're closed on Monday.
Yeah, Monday's President's Day.
Should I call the local Social Security office?
I think it's all 1-800 numbers.
Okay, thank you very much.
Thank you, sweetie. Bye-bye. Let's go to Alex. Hey, Alex, how you doing?
Hey, Esther. Good afternoon, everybody. I recently bought a co-op apartment in Yonkers, New York.
Yep.
Bought it in August of 2016, so I'm around to doing my taxes. So I know when you have a house, when you depreciate it, you look at the cost and you add certain costs. How would I depreciate the co-op apartment?
Okay, so you're renting it. You're renting it out, correct?
No, yeah, exactly, correct.
You are renting it out. You're not. This is not where you live. This is a rental.
Correct. But
all right.
What could you go through both rules? If you own it, how would you depreciate it?
You don't. When you own it and you're living there, you don't depreciate it.
Oh, okay, gotcha.
All right. Depreciation is the effect of you owning a piece of business property, and making rental income is business, and you get to take a systematic write-off of that asset over a period of years. If it's a residential rental, it'd be 27 and a half years. If it's a commercial property, it's 39 years. So in your situation, if it's going to be your own home, you don't depreciate it.
Gotcha. And if I chose to rent it, I would be
at that point in time you would start to depreciate it. But there are very strict rules about what's a rental property. You can't use it for more than 14 days a year personally, or 10% of the time rent it and have it retain a business nature. So, Now, are you really in Yonkers, Alex?
Yes, I'm listening to you over the net.
All right. So why don't you do this? We're all New Yorkers. We're all New Yorkers here. Why don't you call our office at area code 716. It's on our website at EG Tax. 716-632-7886, and then we can talk to you further because I'm running out of time here.
Okay, no problem, guys.
All right. Thanks a lot. Let's see. Go quickly to Cheryl. Hi, Cheryl.
Hi. How are you?
Good.
Good. Quick question for you. My son is buying a FHA foreclosure property to go in on cash.
All right.
Mom and Dad are helping him out.
Yep.
And they're asking us to sign a gift letter for him.
Yep.
Now, we don't want to pay tax on this gift.
You're not going to gifting stuff away is not taxable to the recipient and not deductible to the donor. If you give more than $14,000 per person per year, you have to file a gift tax return, but it's not going to cost you anything unless your estate's worth more than $5.45 million. So you're good, right?
So we're going to loan him $78,000, and he's going to pay us back in a few months.
Well, that's
then that's not a gift.
Okay.
Right?
So it's not considered a gift.
That is, if you're going to get paid back.
Yeah. I mean, if he's paying cash, I don't know why anybody would want to see a gift letter.
That's right. Why would they?
Because the money's in our name, not my son's name. My son's buying the house. We're loaning him the money.
But what? Who's asking for the proof if it's a cash deal?
The FHA wants to know.
But there must be a loan then.
Pardon me?
There must be a loan then. FHA means that it's a loan.
He's buying a foreclosed house, and you can't
for cash.
On it.
For cash.
And now what's going to happen is in 3 months he's going to refinance it and pay us back.
Okay. Okay. Well, again, if it's a gift, it's not going to be taxable to you or taxable to him, so it's not a problem.
It's not a problem.
Okay.
I thought you couldn't give more than $14,000.
You can give more than 14, and you do a gift tax return, but it doesn't cost you any taxes.
Doesn't cost you a return. It doesn't cost you any tax.
Correct.
Okay, great.
Thank you, dear. Bye-bye. I'm Esther Gulius, the tax lady. I got to rush back to the office. We're going to break right now, and we hope that next week we'll talk to you on Saturday from Ask the Tax Lady from 3 to 4. If you need us during the week, visit us at egtax.com. Have a great week. Until next week, I'm Esther Gulius. Bye-bye.